Hello, good people. How are you? I hope you are doing fine wherever you are. I am the ACCA tutor, Mr. Mutimukulu Jerry. Okay, and in this video, we're going to look at the ACCA Taxation UK topic on inheritance tax, IHT. Remember, we are focused on the Finance Act 2024, okay? Finance Act 2024, all right, for the tax year 2024-2025. All right, so when you're looking at inheritance tax, we are looking at things like transfers of value, liabilities, exemptions, and payments. Okay, obviously the liabilities we are looking at are those related to inheritance tax. Okay, the inheritance tax payable on the transfers of value. Okay, and we'll be considering as well the exemptions which could mitigate those liabilities, and the payments. That's when these taxes would be due. Okay, once they are ready to be paid, you need to know when you should ensure that you're not going to be penalized based on delays in remitting those taxes. All right, like in any jurisdiction, obviously the taxman would have set some due dates by which the taxes should have been remitted to the tax authority. Okay, so the United Kingdom, Her Royal Majesty Revenue and Customs, the HMRC, obviously would have some due dates. All right, the HMRC. These are the revenue guys in the UK. So they have set some due dates by which you guys should remit. Or if you are the person who has died, then your executors, the executors of your estate, should ensure that they remit these taxes by a certain due date. Is that clear, ladies and gentlemen? So when talk of inheritance, obviously that's the inheritance you know. All right, you need not to be a lawyer to understand what inheritance is all about. Okay, but you need to be more of an accountant for you to understand what is going on. By the end of the day, if you're just a lawyer or some business manager, you're not going to understand these things unless you're an accountant. All right, so let's get the deep dive, ladies and gentlemen, and see what we got. So in the exam, this syllabus area can appear anywhere. Okay, anywhere in the exam, be it section A as an objective test question, those multiple choice questions, or section B, objective test case, where we have got a scenario and about 5 questions are attached to the particular scenario, or section C as a 10 marker. Okay, sometimes it comes as a 10 marker, and you should be able to then, show your, academic rigor in this particular subject area. Okay, so it's good to understand the computations and explanations linked to IHT. All right, you need to understand both the computations and the explanations. Sometimes computations earn you less marks, so you need to at least know some theory, right? But at the same time, it annoys examiners if you do not know, if you do not show some, some idea in the computation thereof. So you need to be able to balance these things such that you know the workings involved, as well as the templates and the theoretical aspects related to explanations. You need to explain this particular text area. Understand some additional aspects like reliefs, exemptions, etc. Right? Because, hey, this is a very tricky exam area. It is also, or it is often tested in combination with capital gains, chargeable gains, or the capital gains tax. All right, that's an overview, ladies and gentlemen, and our lecture objectives are that by the end of the lecture or the week, remember our study program is structured that such that the lectures are on a weekly basis. All right, so by the end of the week or by the end of the lecture, you should be able to identify persons chargeable to IHT. Right? Who are those people who are chargeable to inheritance tax? Understand the concepts of transfer of value, chargeable transfer, and the PAT, the PAT. Okay, PAT. You need to understand that the potentially exempt transfer. You need to know what it entails. Okay, what are the tax treatments related to it? Okay, then you should be able to apply diminution in value and 7-year accumulation principles. Okay, diminution. We need to be comfortable to explain. In explaining this term, diminution in value, right? Then compute lifetime and death tax liabilities, including use of the new rate bands, right? So, inheritance tax, even if it is about inheritance, you should as well understand that even if you are still alive, there are certain taxes you need to pay, okay, in relation to your gifting. All right, so once you be alive, yes, we're gonna tax you on certain transfers which would have made. All right, then apply key exemptions to reduce or defer IHT, right? We need to be able to apply those exemptions. Then last but not least, identify responsibility and due dates for IHT payment. Then we call the topic done. Isn't it so? Thank you. Let's move on. Now, the key definitions. Quite often your examiners, would, test you on your theoretical understanding of these important definitions. They are actually essential as part of your skills when it comes to explaining things or explaining the IHT theory. Now, what is transfer of value? This is any gratuitous disposition made by a person which results in a diminution in value of that person's estate. Okay, diminution is like the decrease in value or the deterioration, or the reduction, of the person's estate or the value of his estate. Thus, it is a transfer that reduces the value of a person's estate. So, if the transfer doesn't result in the reduction of the person's estate in terms of value, then we can't say diminution has resulted. Okay, or a transfer would have resulted or would have occurred. We won't infer or make that inference because the estate has not been reduced. All right, so it will be difficult for the taxman to prove that IHT should be paid in those situations. Now, what about chargeable transfer? This is a transfer of value not covered by an exemption. Okay, so when we arrive at the chargeable transfer, then obviously exemptions won't be of any help or would have been considered, right, as we were, dealing with the transfer of value. And then we then, subject the transfer to some exemptions, and then we arrive at what is called the chargeable transfer, right, or the transfer that can now be taxed. Now, what about third, potentially exempt transfer? This is a gift to an individual. Please get this right. A gift to an individual. A gift from an individual to an individual. All right? Or let me just say, a gift to an individual that becomes exempt if donor survives 7 years. Okay, so when you give out this particular gift, it is potentially exempt in the sense that sometimes if you manage to survive 7 years after giving the gift, then that gift can no longer be, chargeable. All right, for IHT purposes, it will be, a free gift without any tax attached, provided the donor survives for 7 years. Now, why are we saying it is potentially exempt? Because not all gifts are exempt, but this particular gift, which has been given to a person, is potentially exempt in the sense that we do not know, we are not guaranteed that the donor is not going to make it, is not going to survive for 7 years. All right? So we can't say the gift is outright exempt. Why? Because death might occur. We're not sure. So it is safe to simply say the gift is potentially exempt, provided the donor is going to survive for more than 7 years. Is that clear? So if they survive for 7 years or above, then the gift becomes 100% exempt to be a free gift. All right. But if they die within 7 years, all right, then it becomes chargeable. Right? It becomes chargeable. However, if they survive for 3 years after giving the gift, all right, if they survive for 3 years after giving the gift, then there is a concept called tapering, right, that could reduce the gift, all those things. I mean the taxation attached to the gift, they applies what is called tapering, and we'll talk about that as we progress with the lecture. All right, then the new rate band, NRB. This is the threshold below which no IHT is payable. So you are entitled to £325,000, right, for the tax year 2024-2025. If your gifts are within this range, then it means they are not going to be, taxable. You're entitled. The tax rate that is going to be applied will be a zero rate. All right, but anything extra, anything above that, is now going to be chargeable. Then there is also a residence new rate band, RNRB. This is additional threshold for passing main residents to direct descendants. So if you pass your residents to direct descendants like your kids, then the new rate, the residence new rate band is going to apply. So in addition to the new rate band of 325, you are also going to enjoy the 175,000 again on the residential property. Actually, this should be the main residence. We'll talk about it as we progress with the lecture. Then diminution in value. Sorry for the cutting. Now, diminution in value is the actual reduction in the donor's estate due to a gift. So, if the gift results in reduction of your estate's value, then that would have been a diminution in value, which is also something that is linked to the transfer of value principle. All right, because a transfer of value would only occur if there was some diminution in value. Okay, the basic principles of transfers of value. Now, who are the persons chargeable to IHT? United Kingdom domiciled individuals. These are taxed on worldwide assets. So your assets need not to be located in the UK. But as long as you are a UK domiciled individual or a UK resident, then you are liable for IHT. All right? That's the concept behind worldwide assets. Right? Even if your assets are in Hong Kong or Zimbabwe or South Africa or China or the United States, as long as IHT applies, then you need to remit the IHT. All right? Good. Then, non-UK domiciled individuals, these are taxed on UK assets only. So, if you are Zimbabwean in the UK, but you owned some estate there, once IHT starts to apply on you, then you need to ensure that you remit IHT based on those assets which are located in the UK. They're not going to pursue your other assets outside the UK if you are not a UK resident. However, do not worry about the non-UK domiciled individuals, because at the moment that part of the syllabus, that part of the area is out of the syllabus. Then trustees, these are chargeable for trust-related transfers or events. So the trustees related to your estate, okay, are going to be liable, or they are chargeable for trust-related transfer, all right? So they will be answerable if they fail to remit IHT in time. Is that clear, ladies and gentlemen? Thank you. Now, let's look at these examples. They've been summarized for you to understand what will be going on. Persons chargeable to IHT. Example 1, UK domiciled individuals. Alistair, who is UK domiciled, owns a house in Bindura, Zimbabwe, shares in a UK company, and a holiday apartment in Spain. Upon his death, all of these assets will be subject to UK inheritance tax. Why? Because Alistair is a UK domiciled individual. All right. So his assets, which are distributed all over the world, are going to be subject to the IHT. Right? They're going to be subject to this particular act or tax. Now, example 2, non-UK domiciled. Naomi, a citizen of Botswana, is considered non-UK domiciled for IHT purposes. She owns a flat in London and shares in a Zimbabwean mining company. Only the value of her London flat will be subject to UK inheritance tax upon her death. So you might be given a scenario in the examination and you need to pinpoint to pick the appropriate figures, because other figures won't be relevant. Is that clear, ladies and gentlemen? Thank you. Example 3, involving trustees. The trustees of the Education Fund Trust hold various investments. When they distribute capital to a beneficiary who is not exempt, this transfer may be chargeable event for IHT, for which the trustees are responsible. Okay, that point is quite loud and clear. All right, self-explanatory. All right, good. Now, types of IHT. There is lifetime IHT on lifetime gift. Okay, we are now into the deep waters now. If I make a gift, or if I give somebody something of value, right? The reason why I say something of value is that some gifts, all right, some gifts are going to be considered small gifts. You understand, as you proceed, and they would be exempt. Okay, they're not going to be charged. So if I make a gift to somebody, all right, and I'm still alive, that gift would be a pact, all right, a potentially exempt transfer. All right, why? Because there is still room or chance that I might survive for the next 7 years. All right, but sometimes I do make a gift, all right, which is called a lifetime gift. So a lifetime gift, you understand it as we proceed. Lifetime gifts which are chargeable to IHT or for IHT purposes are called CLTs, or chargeable lifetime gifts. Lifetime transfers, chargeable lifetime transfers. All right, these are gifts which would have been made. They would have been made to a trust. Okay, don't worry. We'll explain with examples so that you understand what we'll be talking about. But for now, just know that there is a lifetime IHT on lifetime gift. All right, and the reason why we are saying these gifts to trust are chargeable for IHT purposes is that other gifts to individuals are going to be, they are going to be treated as pets. All right, and we cannot charge IHT as long as this guy is still alive. All right, and even if he dies, but if he dies after 7 years, then we are also not going to charge IHT on those gifts. Is that clear? Good. But now, if we die, if after making a gift, I then die, then IHT on death starts to apply on those gifts. Then, apart from those gifts, then I'm also going to leave behind some estate. Is that clear, ladies and gentlemen? Yes, I'll leave behind some estate. Apart from the gifts which I made during my lifetime, I'll leave a house, a car, so many things, shares, all those things, goodies. So, I would be liable to pay tax, or my executors, the executors of my estate, are also going to be, responsible for IHT on that estate I have left behind. Is that clear? So we are looking at three things: lifetime IHT on lifetime gift, death IHT on lifetime gift, and death IHT on death estate. Am I talking to somebody? Good. Types of transfers. All right. The reason why we are going in circles or rounds and rounds is that we want these things to sink in you. You need to assimilate as much data as possible. Remember, I said you need to have the skills of computations as well as explanations. Okay, so there is the transfer of value, all right? That's any action reducing donor's estate value. Then chargeable transfer, that's transfer subject to IHT if no exemption applies. Then potentially exempt transfer, this is a gift to an individual, and we say that this is exempt if donor survives 7 years. The key principles of IHT. IHT looks at tax on the wealth you leave when you die. That's the death estate and lifetime gifts. And we have talked about this where we say that the gifts are in two types. That is the potentially exempt transfers, which are gifts to individuals, and then chargeable lifetime transfers, which are gifts to trusts. Gifts to trusts. Right. So we say that about the paid, no tax unless donor dies within 7 years. There is no tax. Is that clear? Good. Then, for CLTs, these are taxed at the gift. All right. When you give out the gift, then either you need to remit the taxes to HMRC, or you designate the trustees to remit that tax on on that gift by themselves. So there is tax that is going to be charged if you give a gift to the trust to a trust. All right. So if the donor dies within 7 years, then there's gonna be more tax attached to that gift. Okay, on top of the immediate tax, there is going to be additional tax if you die within 7 years of making that gift. Is that clear? But don't worry, okay? We're gonna have an example for that. Okay? Types of transfers. Examples. Number 1, transfer of value. Ben sells his vintage car to his nephew for significantly less than its market value. The difference between the market value and the sold price is a transfer of value, reducing Ben's estate. Is that clear, ladies and gentlemen? Sometimes the examiner would want, or even in section A, you might be given a scenario that looks like this, and for you to determine the transfer of value, you just have to say the market value of the car less the sales price or the sales proceeds, and you arrive at the transfer of value, which is then going to be subjected to those exemptions, and then reach the chargeable transfer, and you compute your IHT. Simple as that. As simple as that. Okay? Good. Now, chargeable transfer. Claude transfers £200,000 into a discretionary trust for her children. This is a chargeable lifetime transfer, CLT, and is immediately subject to IHT. So we say that the moment you transfer something to a trust, the taxation there is going to be immediate. Okay? Why? Because if you give to a trust, it is considered a chargeable lifetime transfer. All right? It is lifetime in the sense that even if you die, those trusts are known. Okay, in a normal situation, trusts are known to exist for, let me just say, forever. Okay, or for a very long period. right? A period much longer, even after the death of the donors. Is that clear? Thank you. Then, lastly, the PAT, the PET, the PET, potentially exempt transfer. David gives £75,000 to his daughter, Emily. This is a potentially exempt transfer, PET. If David survives for 7 years after making the gift, it becomes exempt from IHT. It's very simple, isn't it? Now, diminution in value or transfer value principle. The IHT value of a gift is equal to reduction in donor's estate, not necessarily the market value of the asset. Okay? Thus, transfer of value is calculated as value of estate before transfer less value of estate after transfer, and we get the difference, which is the diminution in value or transfer in value. Example, giving away part interest in property. Estate loses more value than market share of gift. Okay, so if we give away part interest simply means that part of the property. If we give away part of the property, let's say if we were having some land, this was the land we were having initially, but we gave away this part. So it means the estate has lost more value than the market value of the gift. Is that clear? Good. Because usually when the land was, let's say, 100 hectares, but now because it has now been reduced to 80 hectares, obviously we are going to fetch less less money. All right, so in that case the diminution would have occurred. All right, good. Let's do this example together. Okay, now let's look at part interest in property. Example 1. Farai owns 100% of a property worth $500,000. He gives a 30% beneficial interest in the property to his brother, Gideon. After the gift, the value of Farai's remaining 70% interest is assessed at £320,000 due to the loss of control. The diminution in value of Farai's estate is, remember we said the value of the property before and less the value of the property after. So before it was 500,000, but now it has been assessed to be 320,000. So the diminution there, or the transfer of value to be chargeable for IHT purposes, should be 180,000. Okay, this is the transfer of value. Okay, the transfer of value. So in the exam, you are likely to get the 180 as part or as option A or B, and then there is also an arithmetic 30% of 500,000, which is 150 as your option A or B or C or D, and you are likely to be tempted to choose that one because you didn't have the privilege of listening to the ACCA tutor. So you're going to fail the examination and you'll be cursing your ancestors when they were not the ones to be blamed. Is that clear? So please, the transfer value is determined by the formula value of estate before transfer less value of estate after the transfer. Then you get your T of V, the transfer of value or in value. Now let's look at the unquoted shares example. Aisha owns 70% of the shares in Aisha Limited. All right. A Limited has £100,000 ordinary shares in issue. All right. So we can safely say that this Aisha Limited, that's A Limited, isn't it? Because you guys can be easily hoodwinked by a little change or a little twist of the data. So we are saying Aisha owns 70% of the shares in A Limited. And A Limited has 100,000 shares. I mean, one pound ordinary shares in issue. So it means that Aisha has got 70,000 shares, isn't it? Because Aisha owns 70% of the 100,000 shares of A Limited, isn't it? That's what it means, okay? With valuations agreed at 70% being £30 per share. So usually in the examination, the examiner is going to give you some tabulation on the values, agreed values with HMRC, that if you're having a shareholding of, say, from 70% and above, or let me just say of 70%, right, then your shares are worth £30 per share. All right. If you're having, let's say, 40% of shareholding, then your shares would be worth £25 per share. You know, it's at the discretion or at the agreement with HMRC. Right. If Aisha gifts 15,000 shares, reducing her shareholding from 70% to 55%, valued at £20 per share, right? So if they are now 55%, or let me just say, if shareholding is 55%, the value of the shares would be £20 per share. That is for IHT purposes, ladies and gentlemen, all right? Now, so initially Aisha was having 70% shareholding. However, after gifting 15,000 shares, her shareholding reduced to 55%, and the share price for IHT purposes reduced from £30 to, £20 per share. The transfer of value is the difference in the total value of her holding before and after the gift. That's the formula, isn't it? You need to consider the shareholding before. Okay, so before, let me just say value before was 70,000 shares multiplied by £30 per share. That was before. Then after, the value after, we are now having 55,000 shares, and the HMRC is saying now if the shareholding is now 55%, then the value of the value per share is now £20. So let's get the difference between these two figures. Here is 200. 21,000. So that's 2.1 million, and here that's 55 multiplied by 20, that's 110. Okay, then we put the 0 and the 3 zeros. So this one is going to be separated, and we will arrive at 1 million. So the reduction in value was 1 million, and that reduction is our T of V, the transfer of value. Is that clear, ladies and gentlemen? Good. Now, the 7-year rule and NRB application. All gifts in 7 years before death are included. So when you will be doing your computations, please do not forget the gifts which have been made 7 years before death. Apply £325,000 NRB starting from oldest gift. Potentially exempt transfers become chargeable if donor dies within 7 years. Taper relief. We talked of the taper relief. I hinted about it at the start of the video lecture. Taper relief reduces IHT if they are more than 3 years before death. So if you make a gift, you need to survive for 3 years. Otherwise, if you die within those 3 years, then 100% of the gift is going to be chargeable. So if you survive after 3 years, for 3 years, then 3 years or more, then taper relief is going to reduce the amount of IHT payable. All right. Now let's look at this somehow complex problem or example. In the 6 years before his death in 2025, Hamza made the following PAT or potentially exempt transfers. In June 2019, £100,000 to his son. So he made a gift of £100,000 to his son. In March 2022, March 2022, sorry. In March 2022, £150,000 to his daughter. So that was the gift. And then another gift was in September 2024 of £80,000 to his grandson. Upon Hamza's death, these PAT become chargeable. The 325,000 NRB will be applied first to the oldest gift, that is the first gift in June 2019. All right, then to the next 150,000, leaving 75,000 of the NRB available for the final gift. The excess of each gift over the allocated NRB will be subject to IHT, potentially with taper relief applied based on the time between the gift and death. All right, don't worry. Let us be a little bit more pedantic. Let us be organized a bit. So let's look at another example. On 16th July 2008, Margaret created a discretionary trust and gave the trustees £320,000 in cash, and she agreed to pay the inheritance tax IHT on this transfer. So this Margaret made a transfer of 320,000 pounds to a trust. Now, she then decided, or she then agreed to pay the tax herself. All right. So if the donor is paying the tax, if the donor pays, here the donor is paying, therefore the tax becomes, okay, the IHT on the CLT is going to be 20 25%, all right, or 20 over 80. All right, that's 25%. If the donor is paying, the tax, then the tax rate to be applied is 25%. But if the trustees are going to pay using the estate, then it means, using the estate transferred, then it means that the tax rate to be applied there would be 20%. Please get that right, isn't it? Good. If the donor is paying, then we are going to charge 25% of the tax as the tax rate, isn't it? Good. On 1 August 2014, she gave £120,000 to her daughter. On 10th September 2014, Margaret gave a further £338,000 in cash to the trustees. The trustees agreed to pay any IHT due on this transfer. So this time, the trustees are the ones that are paying, right? So the applicable rate now becomes 20%. If the trustees are paying, it's 20%. But if the donor is paying, that's 25%. Assuming, this is the requirement, assuming Margaret has made no other lifetime transfers, calculate the IHT due on each transfer. Then the amount of the gross chargeable transfers carried forward. Relevant new red bands NRBs are as follows. For the year 2008-2009, there were £312,000. Now, 2014-2015, there were £325,000. All right, this information you will need it as you would be doing your computations. So let us see the model solution, ladies and gentlemen. Now, I hope my face is not disturbing your visibility, okay, or your vision. Now, we need to be organized, right? You need to tell the examiner what that gift was. Was it a CLT or a PET? All right? Because remember, we are computing the lifetime IHT on lifetime gifts. All right? We're actually computing IHT on lifetime gifts this time. All right? But remember, we say that pets are not going to be charged any tax as long as the donor is still alive. So the first stage now is an assumption that the donor is still alive. So we are computing the lifetime IHT while the donor is alive. And then we'll then compute the death IHT on those gifts, all right? Presuming he dies. So the first gift, as you still remember, was at 320,000, which was transferred on the 16th of July 2008. So July 2008, which tax year is this one? This is the 2008. Okay, 2008, 2009 tax year, isn't it? 0809 tax year. All right, so this is why we are having this particular tax year there, and that was a transfer to the trust, which is a CLT. All right, so you can get some half marker for this by putting identifying that this is a CLT and the date of the transfer. That shows you are organized and you are ready to pass this paper. Then you indicate the transfer of value, which was £320,000. Okay, you can just deal with a gift. You can proceed per gift, okay, or for a gift at a time, okay? For one gift at a time. Sometimes if you want to just have a composite table, you might end up confusing yourself, right? But it's good, that's industrial practice now, right? Especially on Excel, it will be very, very easy, all right? Very easy to do these things. All right, now, we didn't talk of a certain exemption, all right? Because exemptions, we're going to talk about them later on. Okay, fine, but there's no such time, or there's no such chances for saying next time, or maybe at a later time. Why? Because some of these things, they are interlinked, and you can't proceed without, I mean, getting head on with them. So this is the time we need just to be accustomed to the exemptions, right? We'll talk about them later on, but it's very important that we discuss about them here. Now, each year, right, there is what is called an annual exemption. It's like when we are, dealing with chargeable gains in the capital gains tax computations, there was an annual exempt amount. All right, but now this time it's called an annual exemption. An individual is entitled to that exemption. All right, so if you give a gift, the amount of IHT is going to be reduced by the annual exemption. Before we reach to the new rate bands, all those things, there is an annual exemption, right? You're going to get that each time you make a gift. Now, if you make a gift in a particular year, you are going to enjoy 2 exemptions, provided in the preceding year you didn't make, or you didn't enjoy or claim the exemption. So this is why in 2008, when he made the first gift, he's going to enjoy the 2008 annual exemption of £3,000. Then he also enjoys the 2007-2008 tax year exemption, which was the previous year exemption. Are we together, ladies and gentlemen? And then the chargeable amount becomes £314,000. Then we said the chargeable amount is that amount after an exemption, or that has no exemptions attached to it, or that can be claimed upon it. So when you are given a chargeable amount in the examination, do not adjust that amount with annual exemptions. Why? Because a chargeable amount would have dealt with is an amount after dealing with those annual exemptions. Only a transfer of value is going to be subjected first to the exemptions, and then we move on to the NRB, the new rate band. All right, good. So the estate here that has been given was 340, but the NRB as given in the question for 2008-2009 year was 312. All right, so the whole amount, this is the NRB, all right, but we then have to deduct this NRB with any NRBs that have been used in the prior years. However, in this question, there are no NRBs which have been utilized in the past 7 years. There was 0 there, right? So this is why we are coming to 312. Why? Because the whole new rate band that was applicable at that time was not utilized. So this is going to reduce the chargeable amount to 2,000. Okay, so that 2,000 has to be subjected to the 25% tax. Why? Because the donor was had agreed to pay. Okay, remember the question was saying she agreed to pay. Let me tidy up the board. She agreed to pay the IHT on the transfer. So the donor agreed. So that's why we are charging 25%. Okay? Now, come 2014, 2015. This time around, she made a pet. Okay? It was a pet, and it was made on August 2014, 1 August 2014. Okay? This is the pet we are talking about. She gave her daughter £120,000. So that's the £120,000. And then we adjust by the current year, £3,000 exemption, the annual exemption. And the previous year, 2013, 2014. Why? Because she last made the gift in 2008, 2009. Okay, that is on 16 July 2008. So all these years, we're having the annual exemptions which were just being forfeited to the state. However, the state allows you to claim the previous year if you didn't use it. They allow you to do that. So, in other words, the UK are actually a tax-friendly jurisdiction. Their taxes are a little bit, lenient. All right, so they give their people all these enjoyments. Now we come to this. That's the amount that is going to be chargeable for IHT. Now we cannot proceed any further. Why? Because this is a pet and the person is still alive. So no IHT at this moment. No IHT. Okay? Is that clear? Good. But we will consider that amount as we progress. All right? It will constitute part of the gross amount to be carried forward. Okay? The gross amount to be carried forward. All right. Okay. Now, the only problem we have here is that the question does not give us much detail as to when this particular Margaret died. Okay, we don't have that information. So we just have to know that the IHT related to this pet, there is no IHT to be chargeable on the pet as long as Margaret is still alive, and if she survives for more than 7 years from the time of this pet or from the time of giving out the pet, then no IHT to be thought of or to be worried about. As long as she survives for 7 years, it would have been a done deal, a free gift without any tax consequences. Is that clear? Now, we were also told that she made a transfer on the 10th of September to a trust which was £338,000. If you still remember, guys. Good. That was a transfer. All right. Now, we do the same. All right. But now, can we claim exemptions for the, for this other gift in the same year when we have already claimed the exemptions on the pet? Obviously, we are not going to do that. All right. Now, for tax planning purposes, it is wiser to claim the exemptions on the CLT, on the CLT, those 3,000s, the annual exemptions were supposed to be charged on the CLT. Why? Because that's the gift that attracts an immediate tax. The other ones, those other ones could be, because they're not going to be charged now. There is 2 chances that the donor can survive So we can defer those ones. We can actually have some sort of deferment. We then levy those exemptions on the immediate tax. All right, it's advisable that. Okay, but either way, either presentation is going to earn you marks in the examination. Why? Because you have followed the order in which the exemptions have to be applied. All right, we start with the order gift as we proceed. All right, but if you indicate to the examiner that for tax planning purposes, since these were the gifts which were made in the same year, all right, and there's only going to be one exemption applicable in that particular tax year, then obviously you should have, for cash flow purposes, you should have applied the exemptions on the CLT. Why? Because it attracts an urgent tax obligation. Is that clear, ladies and gentlemen? Good. Now, so there are zeros there because we have already claimed the exemptions. Now we come to 338, which is the chargeable amount, and then at this particular juncture, the applicable NRB was now 325. However, we are not going to enjoy the full 325,000. Why? Because in 7 years, in the previous 7 years, that is in 2008, we are now in 2015. Okay, 2015 September. 2014 September. So if we go back 7 years, we will be somewhere around September 2007. So this means that this gift is within. This particular gift is within the 7 years. So the NRBs enjoyed, okay? The NRB enjoyed during that time is going to be, the gross amount that was sustained during that particular period is going to reduce the NRB. All right, the current NRB. Remember, we had a gross chargeable amount of 314,500. So this is going to reduce the NRB currently. Is that clear? It is going to reduce. But how did we get the 314,500? This was the chargeable amount plus the lifetime tax due, all right, of 500, and we arrived at the gross amount carried forward. And that gross amount carried forward is going to affect our enjoyment of the NRB. Okay, so the NRB that is going to be unused this time is only going to be that much. So do not forget to look back 7 years at the time of the gift to take care of n gross amounts payable. Okay, we need to cover ourselves to ensure that we are not going to be scarced with these things. All right, now the remaining NRB, we said that's 10,500, and this is going to reduce this amount, 338. So we will arrive at 327,500, and we'll apply a tax rate of 20%. Why? Because the trustees this time are the ones who are going to pay the IHT. Okay, so 20% of 327,500 is gonna be 65,500, and okay, and because we are told by the question that he made no other transfers or gifts, therefore the carried forward amount amount to be carried forward will remain at 338. That's the gross chargeable amount, or the gross amount to be carried forward. All right, we'll stop at that figure only, waiting to hear if they die. All right, good. All right, all right. Thank you. Let's proceed. Taper relief on lifetime gifts. Taper relief applies to chargeable pets or CLTs when the donor dies within 7 years of making the gift. So, if you die within 7 years, but remember, I said you need to survive 3 years minimum, okay, for you to be entitled to taper relief, for your estate to be entitled to taper relief. All right. Now, how does this reduce the tax? If you do not survive for more than 3 years after the gift, then 100% is going to be applied. There is going to be zero reduction in tax. We are going to tax the full amount of the gift. But if you survive more than 3 years but less than 4, then you are going to enjoy a 20% reduction in the tax. If you survive more than 4 but less than 5, there's going to be a 40% reduction on IHT. Then, if you survive for more than 5 years but less than 6, there's going to be 60% reduction. And then, if you survive for more than 6 years but less than 7, there's going to be 80% reduction in IHT. Then, if you survive for 7 years plus, then there's going to be 100% reduction. That gift becomes tax exempt. Is that clear, ladies and gentlemen? Good. Now, PT with taper relief. Let's do this example together. Imani made a PT of £400,000 to a niece on 1 May 2021 and sadly passed away on 15 July 2025. The gift becomes chargeable. The period between the gift and death is 4 years and 2 months, falling into the more than 4 but less than 5 years band. Therefore, taper relief of 40% will apply to the IHT payable on his gift. The taxable value remains £400,000 less an available NRB, but the tax calculated at 40% will be reduced by 40%. So let us look at this particular tabularized example. Okay, tapering expanded. Kasongo died on 1 March 2025 with chargeable estate of £500, having made the following lifetime gifts. The first gift was 1 October 2012, £100,000 cash to son. Then 1 June 2013, £336,000 cash into trust. 1 September 2019, £296,000 cash to daughter. So, as you'll be reading the question, you need to tell yourself that this one is a pet, this one is a CLT, this one is a pet. Why? Pets are those gifts to individuals, and CLT is a gift to a trust. That should be ringing in your head by now, isn't it? Good. Required. A. Calculate the IHT payable on the lifetime gift when they were made, assuming that Kasongo paid any lifetime tax due. B. Calculate the IHT payable as a result of Kasongo's death. New rate bands are as follows. From 1011, from the tax year 2010-2011, they were now £325,000. The NRBs. All right, good. Now, the gift on 1 October 2012 to her son is a pet. We have already indicated that. This was not chargeable when made, nor will it be chargeable on death, as Kasongo survived for the required 7 years. The transfer is therefore fully exempt, but will be deemed to have used the annual exemptions for 2013 tax year and 2011, 2020, and 2012 tax year. Obviously, this is the current year, and this one is the previous year, the PY, isn't it? Now, the gift on 1 June 2018 is a CLT and was chargeable when made during lifetime, but not again on death, as again Kasongo survived for 7 years. So although this gift was made to a trust, still the 7-year period expired, and this gift is no longer chargeable for IHT purposes. Is that clear? That is, on death, it won't be chargeable. Remember, on death, there's gonna be some additional taxes. All right? But if you die after the 7-year period, yes, you would have paid that lifetime tax during your lifetime. All right? Remember, we said the CLTs attract immediate tax. They're not going to refund you because you die. No, that tax would have been gone to HMRC and it will be gone for good. All right? But because you survived for more than 7 years, then any additional tax attached to that gift is not going to be payable. Is that clear, ladies? Good. The gift on 1 September 2019 is a pet. There was no lifetime tax, but the gift will be chargeable on death, as Kasongo died within 7 years. Now, the 2019 gift, although it is a pet, it is now going to attract IHT. Why? Because this guy died within 7 years. Is that clear, ladies and gentlemen? Good. Let's see. Now, I want you to pay very, very, very careful attention, because this table, ladies and gentlemen, is very, very important for us. Very, very, very important. Okay? Like I said, you need to tell the examiner the year. Okay? The date of the CLT, of the gift, and whether it is a CLT or a pet. And we have been told that this was a gift to a trust, okay, which was made on 1 June 2013, according to the question. Good. Talking of this one. And the other one was on 1 September 2019, which is that one. Okay, and it was a pet. Now, let's start with the CLT, the CLT column. Now, the gift was £336,000, okay? And we need to deduct the exemptions. Now, the exemptions, we were told that only the current year exemption is available. Why? Because previously, it had we had used the current year and the previous year exemption. Remember, the current year had been claimed. The 2012-2013 year was claimed. Now the 2013-2014 year, this is the 2013-2014 year. Okay, so we cannot claim the 2012-2013 year. Why? Because we have used that one as a current year in that year. So we cannot then use it as a previous year exemption this time around. So this time around, that one, there was a zero previous year for this particular gift. Only the current year, the current year exemption was available. Okay, so these are the figures we are talking about, and this is the chargeable transfer. Okay, there is this statement: the annual exemption for 2013 will have been applied on 1 October 2012, PET, despite it never becoming chargeable. All right, the assumption is that it would have been utilized. Now, we then have to compute the gross transfer. All right, the gross transfer. It's very important for us to compute that one. So, when the gift was made on the 1st of June 2013, okay, which was the COT, all right, we said that the chargeable transfer was 333,000. All right, and there is the new rate band to be applied of 325,000. All right, which means that if we subtract 333,000, okay, less 325,000, we get an excess of 8,000 pounds. 8,000 pounds. All right, and the 8,000 pounds has been determined, which is subjected to the tax rate of 25%, which means the tax payable becomes 2,000. Now, why are we charging 25%? Because the donor has made the payment, has agreed, assuming that Kasongo paid any lifetime tax due. So, assuming that the donor paid the taxes herself. So, this is why we are applying the 25% tax rate. Okay? Good. Now, so we are saying the chargeable amount of 333 plus the IHT payable, we get the gross amounts to be carried forward, or the gross amount carried forward, or the gross transfer, or gross amounts to be transferred. Okay, or gross transfer amounts. Yes, gross transfer amounts. All right, so these are those amounts which are going to be applied should this guy dies, provided the death occurred within 7 years. All right, good. But now, remember, this guy died well beyond the 7-year threshold after the CLT. So there is a likelihood that the CLT is not going to be affected by IHT. Okay, but there is always a big but, and we will talk about that as we progress with the computations. On 1 September 2019, there was a gift to an individual, and this individual was a daughter. So this was a pet of 296. Okay, now in 2019, in September 2019, that's the 2019-2020 tax year. So obviously there is a current year annual exemption to be claimed, as well as the previous year. In the previous year, there was no gift that was made, and that means the annual exemption in that year was not utilized. So we are allowed to utilize it this time around, and this reduces our chargeable transfer to 290. Okay, 290. Good. Now, as the donor Kasongo paid the IHT, the transfer is net transfer, and therefore the excess over the new red band is taxed at 25. All right, we talked about that. Good. Now, let's compute the lifetime transfers chargeable on death. Additional tax, the PET on 1 September 2019 is now chargeable to IHT as the gift was made within 7 years of the date of death. Okay, so this lady died when? When did they die? Let me revisit the question. They died on 1 March 2025. So if they made a gift on 1 September 2019, then it means that's within the 7-year period. Okay, so the pet becomes liable for IHT purposes, right? Because it has been made within 7 years of the date of death. When calculating the tax, it is necessary to look back 7 years from September 2019 to see if any gifts will use up the NRB. The CLT from June 2030 does use up the new red band. So we are saying, although this guy died in 2025, right? There was a gift which they made within 7 years, all right? And that gift was also made within 7 years of the preceding gift, which ate up our NRB. Okay, it used up our NRB. All right, that CLT, which was made in 2013, used up our NRB as used to remember in our computations. Okay, our NRB was affected here. Okay, it used up almost everything. The 325,000 pounds was used up during that time. So this is going to affect our figure this time around, as we'll be computing the lifetime transfers chargeable on death. Kasongo has died. So there are implications for IHT purposes of the death. Now, let us look at these computations. Okay, now, there was on 1 September 2019 a pet. Remember, the pet had been reduced to 290,000 after considering the after considering these annual exemptions. We were left with the chargeable amount of 290,000. All right. Now, if we come here, this is the 290,000 we are talking about. All right. There is no new red band this time around. Why? Because it has already been consumed in the 2013 gift. All right. So straight away, we charge the 290,000 pounds with the 40% IHT. Okay. Remember the death tax rate. The IHT tax rate on death is 40%. So the full 40% is going to be charged. And Kasongo or their executors have to pay 116,000 pounds of IHT. But because they died after 3 years of the gift, but within 7 years, there is taper relief. Okay, there is taper relief. So the taper relief here has to be determined after we determine the number of years survived after the gift. The gift was made on 1 September. Yes, on 1 September 2019, and they died on 1 March 2025. So this means that, let us do the mathematics. 1 September 2019. So in 2020, that's 1 year. 2021, 2 years. 2022, 3 years. 2024, 4 years. 2025, 5 years. All right, that's 5 years. Now, we can as well do a number line. Okay, let me draw a number line. Let me forge a number line here. Time of gift 1 September 2019. There is 1 September 2020. There is 1 September 2021. 1 September 2022. 1 September 2023. 1 September 2024. Okay, and they died somewhere in March 25. They died in March 2025. So how many years are we looking at? Okay, how many years? So if we move from 2019 September to 2020 September, that's 1 year, 2 years, 3 years, 4 years, 5 years. Okay, that's 1, 2, 3, 4, 5. So this is 5 but less than 6 years. Why? Because we did not reach 25 September. They died in March. So number 1, this is now 1 year, 2, 3, 4, 5. Okay, years survived were 5 years. Now if we go back to that table, there was a table on taper leaf. If you survive for 5 years but less than 6 years, you are entitled to a 60% reduction in IHT. So we come back to say, where is my 60, our 60%? Okay, so this person's estate has to be relieved of the IHT taxes by 60%. So we then come here and say 60% of 116, this should be 69,600, and this is the figure we are talking about, which is going to reduce the IHT from 116 to 46,400 pounds. Is that clear, ladies and gentlemen? Good. Now, let's now compute the chargeable estate at death. So far, we've been dealing with the gifts which have been made during the person's lifetime. But now, they're also going to leave something behind, some other properties which should also be subjected to IHT. Okay? So we are told by the question that the value of the estate left behind was 500. Yes, I'm sorry, my pen is misbehaving. Maybe it's about the battery power. 500 pounds. Okay? And we're then given the information about the gifts which she made during her lifetime. So the estate is worth 500 pounds. That's the value of the estate. The available new rate band. The available new rate band is equal to 325,000 pounds. Okay, minus 290. All right. Remember, the 290,000 pounds is the gross transfer. I told you that the gross transfers or the gross amounts to be transferred are the amounts which are going to reduce the new rate band. Okay, so the £325,000 are to be reduced by 290 to come to £35,000 pounds, right? Now, we also have the that's okay. Remember, this is the NRB remaining, isn't it? This is the NRB remaining, and the NRB is at new rate. This is why we are seeing a zero being charged there. But we know that the total estate is 500,000. All right. So the balance now, which has to be subjected to the full 40% of death tax, is £465,000 multiplied by 40%, and we have the resulting IHT of £186,000. Okay, so that's the death tax payable by Kasongo or through her executors. Okay, good. So more on taper relief on lifetime gift only applies if the cumulative total of pets exceed the NRB. Apply taper relief to tax, not to the gift amount. Here, the first point simply saying that there won't be any need for doing the taper relief if all the amounts involved have been consumed, have been taken care of by the NRB. Okay, sometimes the NRB deals with everything, and you won't then have to claim taper relief when the amount is now negative, because you are not going to get any refund. So the taper relief is going to be applied on the excess above the NRB. Is that clear? Then you need to apply taper relief to tax, not to the gift amount. Okay? You first have to compute the tax, and then after determining the tax, you then have to apply the taper relief. Works only if donor dies within 3 to 7 years after making a gift. So if they survive 3 years but die within 7 years, then the taper relief applies. Good. Now, IHT liabilities on lifetime and death transfers. This is a very, very important part of the lecture, but we are going to dedicate this to video number 2, okay, because the videos need not to be too long, right? So we are going to dedicate this part of the lecture to the next video. Thank you for that. Thank you for now. Bye.